There's a chart I need to show you. It's not complicated. 2 lines. One is the Federal Reserve's interest rate decisions over the last 3 years. The other is Bitcoin's price. And they move together, almost perfectly. Same peaks, same crashes, same timing. Now ask yourself this. How does a decentralized currency that runs on code, not central banks, somehow know exactly when Jerome Powell is about to speak? It doesn't. But the people controlling the money flowing into it do. And that's the thing nobody wants to admit. Bitcoin was built to escape this exact system. No banks, no government control, no middleman deciding what your money is worth. That was the promise. That was the revolution. And technically, the code still delivers on that. The blockchain works. The network runs. Nobody can shut it down. But they found something better than shutting it down. They made it irrelevant whether the technology is decentralized or not because they control the price. And the price is what everyone's watching. Let me put it differently. Right now, as you're watching this, Bitcoin is trading. Somewhere, someone just bought it. Someone just sold it. And neither of those people are using it to escape the traditional financial system. They're using it to make money within that system. They're buying it on Coinbase. They're holding it in a retirement account. They're watching it move alongside their Tesla stock and their index funds. That's not what Bitcoin was designed for, but that's what it became. And the second it became that, the banks won. Because here's what they figured out. You don't need to kill Bitcoin. You just need to make sure people interact with it the same way they interact with everything else you already control. You don't need to break the code. You just need to wrap it in the same financial infrastructure that Bitcoin was supposed to replace. And it worked. Most people don't even realize it happened. Think about how you first heard about Bitcoin. Maybe it was 2017. Maybe it was 2021. Probably someone told you it was going up. Probably you saw the price chart, and that's what hooked you. Not the white paper, not the idea of financial sovereignty, the number going up. And that's fine. That's human nature. But that's also the exact moment Bitcoin stopped being a threat to banks and started being another product they could trade. Here's what I mean. When Bitcoin was worth $100 or even $1,000, the only people buying it were believers, cypherpunks, libertarians, people who actually cared about decentralization. They held their own keys. They ran their own nodes. They used it the way it was intended. But when it hit $10,000, then $30,000, then $60,000, a different crowd showed up. Hedge funds, investment banks, asset managers moving billions of dollars. And those players don't care about opting out of the system. They are the system. And they brought all their tools with them. Futures contracts, ETFs, derivatives, leverage, all the same mechanisms they use to control stocks, commodities, and currencies. Suddenly, Bitcoin wasn't just trading on decentralized exchanges between individuals. It was trading on the Chicago Mercantile Exchange. It was being packaged into financial products by the same institutions it was designed to bypass. And once that happened, the price stopped being about Bitcoin. It started being about liquidity, about risk appetite.
About what the Fed was doing with interest rates. You see it every time. The Fed signals a rate hike, and within hours, Bitcoin drops. Not because anything changed with the network, not because fewer people believe in it, but because institutional money pulls out of risk assets. And Bitcoin, despite all its revolutionary origins, is now classified as a risk asset. That's the game. And most people holding Bitcoin still don't realize they're playing it. Let me give you a real example. There's a guy I know. Let's call him Ryan. He's 29, lives in Denver. Works in marketing. Started buying Bitcoin in 2020 because he was tired of watching his savings account earn nothing while inflation ate away at it. He believed in the idea. Decentralized money, freedom from banks. He wasn't trying to get rich quick. He just wanted out. So he bought Bitcoin. But he bought it on Robinhood because it was easy, because it was convenient, because that's where he already had an account. And now, 2 years later, he checks the price every day. He watches it swing up and down with the stock market. He sees it crash whenever there's bad economic news. And it frustrates him because this was supposed to be different. This was supposed to be the escape. But Ryan doesn't hold Bitcoin. He holds an IOU from Robinhood. He doesn't control the keys. He can't move it without their permission. He can't use it in a peer-to-peer transaction. All he can do is watch the price and hope it goes up. That's not financial freedom. That's just another brokerage account. And that's exactly what the banks wanted. They can't stop you from buying Bitcoin, but they can make sure you buy it in a way that keeps you dependent on them. They can regulate the platforms. They can control the access points. They can create financial products that give you exposure to Bitcoin's price without ever giving you actual Bitcoin. And the price? They can move that too. Not by hacking the blockchain, not by changing the code, but by controlling the flow of money into and out of the market. When they want it to go down, they pull liquidity. When they want it to go up, they flood it with capital. And because most Bitcoin trading now happens through their systems, on their platforms, with their leverage, they have more influence over the price than any group of individual holders ever could. Here's the part that should make you uncomfortable. Bitcoin's price is now more correlated with the stock market than it's ever been. It moves with tech stocks. It crashes with the Nasdaq. It responds to the same macroeconomic signals that move every other asset the banks control. That's not a coincidence. That's the result of Bitcoin being absorbed into the traditional financial system, not through force, through adoption, through making it easy and convenient and accessible in ways that kept the power structure exactly where it was. The banks didn't kill Bitcoin. They didn't need to. They just made sure that even if you own it, you're still playing by their rules. Now here's where it gets really interesting, because this isn't just about control, it's about perception. The banks understand something most Bitcoin holders don't. Price creates narrative. When Bitcoin's going up, everyone talks about revolution and freedom and the death of traditional finance.
When it's crashing, everyone calls it a scam, a bubble, a failure. But the technology didn't change. The code is the same whether Bitcoin is at $60,000 or $20,000. The only thing that changed is sentiment. And sentiment is easy to manipulate when you control the liquidity. Think about what happens during a typical Bitcoin crash. Leveraged positions get liquidated, stop losses trigger, panic selling begins, and who's on the other side of those trades? The same institutional players who just pulled their money out. They're buying at the bottom, accumulating. Then when the market recovers, they push the price back up, retail investors rush back in, and the cycle repeats. This isn't conspiracy theory stuff. This is how markets work when there's a massive imbalance in capital. The players with billions of dollars can move markets. The players with a few thousand can only react. And Bitcoin, for all its decentralization at the protocol level, has incredibly centralized liquidity at the market level. A handful of exchanges process most of the volume. A handful of wallets hold most of the supply. A handful of institutions control most of the leverage. So when people say Bitcoin is decentralized, they're technically right, but they're also missing the point. The network is decentralized, the market isn't, and the market is what determines the price, and the price is what everyone cares about. Here's what most people should be doing, but aren't: separating Bitcoin the technology from Bitcoin the investment. If you believe in the technology, then act like it. Hold your own keys, use a hardware wallet, understand that the day-to-day price is noise. Understand that volatility is the cost of opting out of a controlled system. But if you're just buying it hoping the number goes up, then be honest about that. You're not opting out of anything, you're speculating. And there's nothing wrong with that, but don't pretend it's something it's not. Because right now, the vast majority of people are doing the latter while telling themselves they're doing the former. They're checking prices on apps controlled by centralized companies. They're holding Bitcoin on platforms that can freeze their accounts. They're reacting to every Fed announcement like it's a stock portfolio. And the banks love that, because as long as your behavior looks like every other investor, you're not a threat, you're a customer. The real shift happens when people stop treating Bitcoin like an asset and start treating it like a tool, when they use it for what it was actually designed for: peer-to-peer transactions, censorship-resistant savings, a hedge against currency debasement that you actually hold, not just speculate on. But that requires effort. It requires learning. It requires accepting that the easy path, the convenient path, is the one that keeps you locked into the system you're trying to escape. And most people aren't willing to do that. So they stay on Coinbase, they buy the ETF, they watch the charts, and they wonder why this revolutionary technology keeps acting like everything else. The answer is simple. It's not the technology that's the problem, it's how you're using it. And until that changes, the banks don't need to kill Bitcoin. They just need to keep you comfortable enough that you never actually use it the way it was meant to be used. That's the real manipulation, not the price, the behavior.